What's up, everybody? My name is Zach Pascarello, and my goal is to teach you how to become a bookkeeping expert so that you can open up your own bookkeeping business and live the life that you've always wanted to. It's kind of cliche to say, honestly, but that's exactly what happened to me 3 years ago. I started a bookkeeping business while I was working full time in a warehouse, and I hated working in the warehouse, and I loved doing bookkeeping and accounting. And 4 months after I started my business, I was able to quit my full-time job and just focus on bookkeeping and my business. I've had a bookkeeping business for 3 years now, and I'm making six figures every year, and I did it with little to no experience. And my whole goal with these videos is to teach you how to do exactly what I did. And today, we're going to nerd out with accounting specific stuff. That way you can become a true bookkeeping expert. And in this video, we're going to talk all about journal entries. So if you're a business owner, you don't need to worry about journal entries, but if you are a bookkeeper or an accountant, you need to know how to do journal entries. This is the stuff that's going to set you apart from the office administrator or the secretary or the admin person doing books for the business owner. This is going to enable you to take your accounting knowledge to the next level. It's one thing to know how to use the QuickBooks software, but it's a whole another thing to understand debits and credits and journal entries. And today I'm going to show you some specific examples of journal entries that I use on a regular basis with my small business owners. So first of all, you need to kind of understand double entry accounting. That means that every journal entry is going to have two entries. You're going to have a debit and you're going to have a credit, and the debits and credits always need to match. So for example, if you are debiting the expense, you need to credit the checking account, or if you are debiting the asset, then you need to credit the income account. And that might not make any sense to you, but I'm going to show you on the board here some specific examples of debits and credits. Okay, I'm going to start with this one because whenever I take over somebody's books, this is a very common one that I do. So for example, if I'm starting somebody's books fresh in 2023, they might have had business operations in 2022, but we're not capturing any of that. We are just starting fresh in 2023. So we need to show that there is money in the checking account. So there is an opening balance on the checking account, and this is the only time I recommend you use this equity category. Okay, so for the opening balance, if you're taking over somebody's books and they have a checking account with a balance in it as of December 31st, 2022, here's what you would do. Okay, so you could call the checking account whatever you want: cash, checking account, savings account. It doesn't matter what you call it, but this is the checking account. So look at the bank statement as of 12/31/2022, and whatever the ending balance is on the checking account, that's where you're going to debit. So you might need to do a journal entry for the opening balance equity. So we'll just use the dollar sign. So make the entry a debit for the cash account or the checking account, and then you're going to credit the opening balance equity account. So if you look at this, is not going to affect the income statement or the profit and loss. This is only going to affect the balance sheet. So if you've only done this journal entry, if you look at the balance sheet, you're going to have a balance in the cash account and a balance in the opening balance equity account. Okay, now we're going to do a journal entry for purchasing a vehicle. So a vehicle is an asset. So we're going to do two examples. We're going to assume that this person bought the vehicle just with straight cash. No loan was involved. So in this example, we're going to do a journal entry. We're going to debit the truck. You can name it whatever you want: vehicle, truck, car, 2022 Ford F-150 truck, whatever you want to call it. Debit the truck for the amount. Look at the bill of sale, and whatever the amount of the purchase price of the truck, and then credit, whatever the amount of the money that came out of the checking account. So I spent $10,000 cash for the truck, so credit cash because $10,000 came out of my checking account, and then debit $10,000 for the truck. Now, if it's a clean transaction like this, there should be a bank transaction that matches this perfectly. But it's usually not a one-for-one money for truck transaction. So in this situation, they might have put down a 20% down payment and then took out a loan for the outstanding balance of the truck. So in this example, now we need to look at the loan origination document and the bill of sale and the checking account. So this is all one journal entry. So this debit right here for the truck is the total purchase price of the truck. And then this cash is probably like a 10 or 20% down payment. This money actually came out of the checking account. And then another credit for the loan account for the outstanding balance, whatever the difference is between the 10 or 20% down payment, and the original purchase price of the truck. This is why it's so important that you ask your clients, hey, give me the bill of sale, give me the loan origination document. I need these statements because these statements and these documents have all of the information that you need. Okay, while this loan concept is fresh on our mind, let's talk about paying off your loan on a monthly basis. Okay, so $1,000 of cash is going to come out of your checking account, and you're going to pay off your loan. At first, it might look like super simple. We're just $1,000 coming out cash, $1,000 going into the loan. So credit the cash account, debit the loan account. It looks simple like that. However, if you look at your monthly loan statement, you're going to see that the loan principal and the interest expense are split. So here's where we need to take the difference. We need to find out how much of this cash, this credit to cash, how much of that went towards loan and how much of that actually went towards interest. So if we look at our monthly loan statement, we're going to see two numbers. We're going to see the total amount come out of our checking account split into the loan amount and interest amount. And it's important that you capture this because this loan and this cash is not affecting your profit or loss or your income statement. This is just balance sheet stuff. So this is not affecting your bottom line, your profitability when it comes to taxes. So you need to capture that interest expense because that is a business deduction for your client. So capture that on a monthly basis. That way when you run your P&L in real time, they can see, okay, I spent $500 last month on interest. Okay, now let's talk about a security deposit. So there's two types of security deposits. We're going to talk about the first one. I am buying an asset. So you pay a security deposit oftentimes, like if you got to put a down payment on a vehicle or a house, just in good faith, just saying like, hey, I'm reserving my spot. I'm going to buy this property. I'm going to buy this truck. So here is a $1,000 security deposit. It happens a lot with my real estate investors. So you're going to credit cash because you're decreasing cash, you're spending cash, and then the security deposit is an asset account. It's an asset. So now you have a debit to your security deposit, which is an asset. So if you look at your balance sheet, your cash account is decreasing with a credit, and your security deposit account, which is an asset, is increasing. So now you have this $1,000 sitting on your balance sheet, and I'm going to show you what happens to it next. Okay, so you just put down $1,000 of a security deposit. So before we had a credit to cash and a debit to security deposit, which made sense because security deposit was an asset. We had this $1,000 that we gave to somebody. Okay, so now we are buying a property. We're a real estate investor. We're buying a property. You always want to make sure anytime one of your clients buys a property, get the HUD statement. Every time you buy a house, it's going to have some sort of HUD statement, and this will have all of the debits and credits lined out for you. So first of all, you're going to purchase a building. A building is an asset, so you're going to debit the purchase price of the building. And so that's going to be, let's just say $100,000 debit, $100,000 debit for the building, and then the $1,000 security deposit comes out. Okay, now we're losing the security deposit, so the security deposit is going to the seller of the house. So now this is off the books. We had a debit originally, and now we're crediting the security deposit. And then the mortgage, let's say the mortgage is going to be for $90,000. So now if you look at our balance sheet, we're going to have an asset of a building for $100,000. Our security deposit account should be zero. And then our mortgage is going to be $90,000. We're going to see a liability on our balance sheet for the outstanding mortgage. And then finally, there's a $9,000 discrepancy. So we probably are going to send them a check for $9,000. So we're going to credit the cash account for $9,000. So if you look, $100,000 building, $90,000 plus $1,000 plus $9,000, $100,000 equals $100,000. Debits and credits match, and all of these numbers should be straight from the HUD statement. Okay, now I'm going to talk about opening balance equity for a credit card or a loan. It's a little bit different. So before, I debited the cash account and credited the opening balance account, but credit cards and loans are liabilities. Okay, so for a credit card opening balance equity, this is only going to happen if you take over somebody's books brand new and they don't have any entries from 2022. You're starting fresh in 2023 or whatever year, and they have an outstanding balance on their credit card. So here, we need to credit the credit card account and debit the opening balance account. So this is the opposite. So we're going to show an increased amount on the credit card and then a decreased amount on the opening balance equity. So this number is, if this is the only thing we have on this books, it's going to look like $1,000 on the credit card account, negative equity $1,000 in the opening balance account. So it's flip-flopped with the checking account and the credit card. Okay, now this is a little bit different. This is a security deposit, but somebody's giving us the security deposit. So let's say I have a laptop and I'm giving the laptop to one of my students and they are giving me a $200 security deposit. And then at the end of the course, they will return the laptop and I will return the security deposit. So we will receive the money. So we debit the cash account because they're giving us $200. And then the security deposit is the liability account. So we credit the security deposit because we owe them this money back. So it's technically a liability on our books. So we receive the $200, but eventually we're going to give it back. So it's a security deposit, but it's a liability, not an asset this time. So you credit the liability account and debit the cash account. Okay, a couple more journal entries I want to talk about. Owner's pay. So if you have a single member LLC and the owner of the business withdraws $1,000, this $1,000 is going to come out of the cash or the checking account. So we credit the cash account for $1,000 because we're losing $1,000. We're spending $1,000, but this does not show up on the income statement or the profit and loss statement. This is not an expense. This is owner's pay. Owner's pay is an equity account, so we debit the equity account for $1,000. Owner's pay, if this was the only transaction on our balance sheet, it would look like negative $1,000 cash, negative $1,000 owner's pay. Okay, now the last thing I'm going to talk about, let's reverse the owner's pay. So imagine you just started a business and you take $1,000 of your personal money and you put it into your business checking account. So now your cash account has $1,000. What do we do with that? On the other side, we credit owner's investment. So we are increasing our equity by $1,000 and increasing our cash account by $1,000.